Good morning, everybody. Thank you for joining us on our latest webinar, Key Tax Considerations when Restructuring a Business. We will be taking questions at the end of this webinar, if time allows. So if you want to pop your questions into the Q&A section and we'll review them at the end. If by any chance we don't get to answer all the questions, don't worry. We'll save them and we will answer them via email. We're just getting started, so if you can just bear with us for a minute or so, and Clive will be joining us. Thanks ever so much.
Good morning, everyone. Clive Howarth, Associate Director here at ETC Tax. Let's skip the first slide. So we're going to look at key considerations when restructuring a business. What we're going to look at, company purchase of own shares, share-for-share exchanges, particularly insertion of a holdco above a trading company, the substantial shareholding exemption, and finally, capital reduction demergers, which are becoming increasingly common of late. So first of all, let's look at purchase of own shares. Why do we want to do a purchase of own shares? Commonly an exit route for a shareholder. One of the shareholders wants to retire or go and do his own thing or whatever. But there isn't anybody willing to come in and buy those shares from him or her. Sometimes ownership wants to remain within the family, so an external shareholder isn't ideal for them. But commonly, the shareholders don't have the money to purchase the shares themselves. So a purchase of those shares makes sense in those circumstances. So the Companies Act 2006 allows a company to repurchase or buy back their own shares. These shares can be immediately cancelled or they can be retained by the company as treasury shares. There is a limit of 10% of the nominal value of the shares that can be retained in treasury. Treasury shares can be sold for cash to raise funds, but more commonly retained so that it can be used for some type of employee share scheme at some future date. And as far as the tax treatment goes, income treatment or capital treatment, by default, a purchase of own shares is treated as a distribution and would be taxed as a dividend effectively. But capital treatment is available provided that various conditions are met and HMRC clearance is recommended, which is under section 1044, Corporation Tax Act 2010. So let's look at the conditions, the main ones that need to be satisfied. Must be a trading company and for the benefit of the trade. Usually quite easy to justify that particularly if it's a retiring shareholder. The seller must be UK resident and must have held the shares for 5 years. There's got to be a substantial reduction in the number of shares held if retaining some shares. Typically that would be somebody wanting to hold on to some shares for sentimental reasons. If you're still substantially reducing, which is you've got to earn less than 75% of what you owned before, you may have trouble convincing HMRC that it's for the benefit of the trade. So the various Companies Act requirements as well. Copy of the buyback agreement to all shareholders, which is fairly obvious. Companies House filings, a couple of forms there that needs to be completed and sent in. The articles of association should be checked so they allow a buyback of the shares. Importantly, payments must be made in cash on completion and it must be out of distributable income. Don't forget that stamp duty applies, so 0.5% stamp duty payable on the consideration. And here's one: HMRC must be notified within 60 days of completion, specifically mentioned at section 1046. That is very important and is sometimes overlooked, which can be quite costly. I would say that's quite a common pitfall that people need to be aware of. So if we move on now to share for share exchange. What is a share for share exchange? Well, quite obviously, one or more shareholders exchange shares they hold in one company for shares in another company. Most commonly, it will be the insertion of a holdco put on top of an existing trading company. And quite simply, the shareholders in Tradeco exchange their shares for shares in Holdco. Providing the conditions are met, share for share exchange is not treated as a disposal and will fall within the no gain, no loss reorganisation rules. Effectively, the new shares stand in the shoes of the old shares, and that's section 135 TCJ 1992. Here we have the example: Mr. A, Mrs. B, Tradeco, Holdco inserted above. They swap their shares, so they now are shareholders in Holdco, and Holdco owns 100% of Tradeco. There's no stamp duty provided there's a mirror image, so that if the same shareholders in Holdco as there were in Tradeco, there's no stamp duty. But if there is a change in shareholders, then stamp duty will apply. We previously looked at purchase of own shares. Now, if there aren't enough distributable reserves, you might want to insert a Holdco above Tradeco, and then some shareholders exchange for shares, and the outgoing shareholder doesn't have shares, he gets cash instead. So in that case, there wouldn't be a mirror image and stamp duty would be payable. So that's an alternative for purchase of own shares. Also, commonly where there's a management buyout, so the existing management team that want to come in and take over the company would form a holdco, and there would be some sort of reorganisation where the existing shareholders either exit or dilute as part of the process. So the commercial and tax benefits of group structures. Asset protection, most commonly the trading premises or surplus cash would be divvied up to Holdco, so that should the trading company get into difficulty, those assets are protected. Administration and central management, if there's a couple of subsidiaries, can be easier. Tax-free dividends, obviously no tax on dividends between group companies. And assets can be transferred into group at no gain and no loss. They're in diagrammatic form. So here we've got the property and cash going up to Holdco. You could, of course, do it the other way around. You could have Tradeco and form a subsidiary and hive the trade down to the new subsidiary if you were wanting to sell that subsidiary at some future point in time. As an alternative, you could, of course, form a new co with the same shareholders and transfer the trade across. I have to say that's not very common because of the practical difficulties that causes in terms of new company. Suppliers get a bit twitchy about why you've used a new company, etc., etc. So not very common, but can be done. Next, we want to look at the substantial shareholding exemption. Selling company must hold an interest of at least 10% of the target's ordinary share capital. Must be beneficially entitled to at least 10% of the profits available for distribution, and on a winding up, be beneficially entitled to at least 10% of the assets in the winding up. The seller must hold or have held the interest described above throughout a 12-month period beginning not more than 6 years before the disposal of the relevant shares. So quite a big window there to meet the requirements for the SSE. And the target company, from the start of the latest 12-month period, the target must be a qualifying company, and it will be a qualifying company if it is a trading company or the holding company of a trading group. Once upon a time, the selling company also had to be a trading company, but that rule was relaxed a few years ago. Provided the conditions are met, proceeds received by the selling company are tax-free. Where there's only a holdco and a trade co, and the trading company is sold, so the cash goes up to the holdco tax-free. If the shareholders want to claim BADR, you would of course have to then liquidate holdco, and you'd have a 3-year period in which to do that. Alternatively, holdco can be retained and effectively then becomes a family investment company, a FIC as we call them. If the intention is to use it as a FIC, then consider pre-sale planning, such as putting shares into a family trust. This is especially relevant now with the new rules for business relief coming into play from April. Shares can be transferred into a trust without any without limit really, because business relief applies. From April, the trust would have its own £1 million limit for business relief if the company's carrying on. But if it's sold, then you've managed to get some money into the trust. It will still likely be a discretionary trust and be liable for 10-year charges, etc. But still a useful planning mechanism there. What you could also do is put in pre-sale some kind of growth share in holdco, which may be useful as well. Next, I'd like to look at capital reduction demergers. Becoming very popular these days, and it's most common it's because you want to separate out the trading premises or some other property in a company prior to a sale. We're doing one at the moment where the buyers want the business, but they don't want the property that it's operated out of, because they've got their own premises and commercially it's not required for them. So if the property was simply transferred out, CGT, or rather corporation tax on chargeable gains, will be payable, and there'll also be SDLT. So what we do is a capital reduction demerger, which enables property to be transferred out at no tax cost. although there will be significant professional and legal costs. It's quite a complicated process legally, so the legal costs will always be quite heavy and quite justified, I'm afraid. There are lots of requirements to go through, such as some statements that have got to go in, etc. So it's best really to illustrate it by example, which I'll look at now. And I've put some values in to sort of make it hopefully a bit clearer as to what the process is. So we've got Mr. Anderson and Mr. Broad, 50% shareholders in A Limited, which let's say has the commercial premises in it are valued at 500,000. C Limited is the trading business valued at 3 million. They've also got B Limited, which is let's say a property company with £1 million worth of property in it. So a buyer's going to come along and say, well, I'll give you 3.5 million for A and for C, but I don't want B. So we have to demerge B prior to the sale. So the first step is to insert a new holdco above A Limited. So that's a straightforward share for share. And what we do is do that at market value to increase the share capital so that we can reduce the share capital ultimately. So we have an overall value of 4.5 million. So we've now got 4.5 million of shares in Holdco. Next, what we do is A Limited does a dividend in specie of B Limited up to the new Holdco, so that B Limited is now a wholly owned subsidiary of Newco, and A Limited has C Limited only as its subsidiary. The next step is to redesignate the shares in new Holdco so that A shares attached to A Limited and B shares attached to B Limited. So again, using the same values, we've got £1 million worth of B shares held 50-50 by Anderson and Broad, and £3.5 million worth of A shares similarly held 50-50. And the final step here is to reduce the share capital by cancelling the B shares. So to do this, the shares in B Limited are cancelled and distributed to Newco 2 from New Holdco. And Newco issues further shares to the shareholders in Newco 2 as consideration. So the final structure then is that we have New Holdco with its structure of A and C, which can then be sold on, and we've got Anderson and Broad 50-50 shareholders in Newco 2 owning the property portfolio. So we've managed to achieve what we've achieved without any tax cost. Very important that you get HMRC clearance for all these steps. Without it, I don't think anybody would go through a demerger without getting clearance. So normally not too many questions asked really, as long as it's for bona fide commercial reasons. HMRC seem to be quite acceptable to granting clearance on demergers generally. And really, ladies and gentlemen, I think that's all I've got to say on those issues. And I'm hoping that we've got a few questions that I can take, that I can answer. Don't miss out on our next free live webinar, 23rd of October, which is on inheritance tax, the upcoming changes from April, obviously will be quite important. So thank you for that, and I'll hand back to Sarah, and she can hopefully have a few questions for me.
Thank you very much, Clive. Yeah, I've got a couple of questions that have come in. So, on purchase of own shares, how long does HMRC clearance usually take? Has HMRC given clearance when later refused capital treatment?
Um, at present, purchase of own shares clearances tend to come back fairly quickly. I had one that came back about 6 months ago, came back in 4 days, I think, something like that. But generally within a couple of weeks you can get clearance, usually. Has HMRC ever refused capital treatment? I can think of one occasion at a large firm I was working for, and it was the 60-day notification. They hadn't done it, so they thought they'd done it, and when capital treatment was claimed, HMRC said, "Well, why are you claiming capital treatment? You've not adhered to to the rules." So that caused a bit of a dusting off of the insurance policy, I think.
Oh.
But yeah, generally, if you've got the clearance and you've done the notification, everything's fine.
Another question's come in. On share for share exchange, do you have to get clearance?
No, the short answer is no. You don't have to get clearance, but share for share exchanges are only valid if it's for bona fide commercial reasons. So, providing you're confident that it is a bona fide commercial reason, then no, you don't have to get clearance. As there is a specific provision for you to get clearance, I'd always take advantage of that. HMRC are pretty notorious for not giving clearance unless they absolutely have to. So unless there's a specific legislation that says they have to give clearance, they probably won't. The non-statutory clearance procedure, my experience of that is very mixed, and HMRC will often not give you a clearance because they say, well, there isn't a, it's only if there's a point of uncertainty, and they'll say, well, there isn't a point of uncertainty, which, is just an opinion. So my opinion is that they're not very good. But I would always, if you're doing it, as we mentioned in the presentation, if you're forming a holdco with a view to one of the shareholders exiting, then they're going to be getting cash rather than shares, and they're going to be claiming capital treatment on that, on the amount they've received. So you definitely want to get clearance on that, because otherwise HMRC could argue there's transaction insecurities, so that they end up paying income tax on the amount they've received, which obviously wouldn't be very good. So yeah, You don't have to, but I would always go for it. Yeah.
Do you require clearance for stamp duty and share-to-share exchange?
Uh, if it's you've got to apply for stamp duty clearance on a mirror image, you've got to do a separate application. You can't get a clearance for it, but it would always get allowed if you've already got clearance. So that's probably another good reason to get clearance from HMRC. So if you've got the mirror image where the same shareholders in Holdco as Tradeco, in that example, um, then post-transaction you send in a clearance application to the stamp office.
I've got a question about shares next. Could a husband buy his wife's shares under purchase of shares if companies owned 50/50? And what is the tax treatment?
Uh, the so say that again. Say the question again. Sorry.
Sorry, could a husband buy his wife's shares under purchase of shares if companies owned 50/50? And what is the tax treatment?
Uh, well, husband and wife is it's no gain, no loss. So it's not a purchase of own shares or anything. That's just a transfer of shares into spouse. So it wouldn't have any. There'd be no tax implications of that.
Okay. Are anti-avoidance rules complex in the purchase of own shares?
Not particularly complex if the legislation's followed, and that's pretty clearly set out. I think it's section 1033 onwards of the Corporation Tax Act 2010. So the main requirements that we went through, as long as you follow all those, I think the main difficulty is distributable reserves. Um, and in some cases, or in a lot of cases, there aren't the distributable reserves, or the company's cash flow can't sustain an immediate purchase of, 500,000 or 1 million or whatever it is. So what used to be common is multiple completion. So the outgoing shareholder agrees to sell the shares, but sells them in tranches over, say, 3 or 5 years. That used to be okay, and then HMRC have moved the goalposts a bit and said that you're still connected with the company if you've only sold one tranche of shares. Although you've committed to selling the others, you still nominally hold them. So we think you're still connected with the company, and therefore it's treated as a dividend. So yeah, not so it's got to really be cash on completion.
Someone's just after a bit of clarity here with their question. As a sole trader looking to move into a FIC, did I understand correctly that sole trader moves initially to a trade company as the first steps?
Do you mean a sole trader incorporating into a limited company?
I'm not
That's
sure. I will get clarity on this question and we will answer it in the email when we send the slides and the recording out. I
yeah.
think
I'll just say, yes, a trader can incorporate if there's property involved, then there might be SDLT payable, but incorporation relief should still be available. But yeah, get some more details. We'll happily send an email.
Yeah, will do. Can you transfer a property from one company to another company within a group without tax implications?
Yeah, intergroup transfers of property are transferred at no gain, no loss. Section 171, I think it is. TCGA 1992. What you've then got to watch is that if the company that receives the property then leaves the group, there's a degrouping charge. But yeah, intergroup, you can basically transfer assets around as you want.
Okay, and the last question is, in your previous example, instead of capital reduction strategy, can we just transfer the property into a holdco?
Yes, you could. Yeah, if that's what you want to do. That's back to the earlier example. If that's what you want to do, you can just transfer the property up to a new holdco, and then sell the trade co and claim SSE. So you could do that. But in a lot of cases, you want the proceeds and you want them personally, to be subject to capital gains tax and claim your BADR. So that's why you commonly do the capital reduction demerger.
Okay, perfect. Right, I think that's everything. Thank you once again, Clive, for another great webinar. And as Clive's mentioned, our next webinar is happening at the end of October on inheritance tax. So I hope you can all join us for that. We will send the slides and the recording out hopefully today. And there'll also be a link to sign up for our next webinar next month. Thank you once again, and thank you, Clive.
Thanks, everybody.